without further ado, let us give a round of applause to invite Paul here. Thanks, Paul.
Good afternoon. Thank you. It's a pleasure to be here today. Prices rose rapidly as the world opened up after the pandemic. That's only been compounded by the war in Ukraine, impacting energy prices. More recently, we've seen an interest rate shock. We've seen major central banks tightening monetary policy in response. And now we face some concerns around a global economic slowdown. So the IMF predicted global economic growth to fall to just over 2.7% next year. Now, what does this mean for residential markets? I'm going to start by talking about some of the global markets before I turn to London. Well, certainly starting with the mainstream markets, we've seen a period of very cheap mortgages, and that's just changed, as this chart shows. So this shows standard mortgage rates for the last 3 years in key countries. And in the US, for example, where a 30-year fix is common, that's gone from just over 3% to nearly 7%, and a similar trend across the world. So this is clearly going to put pressure on affordability. It's a significant headwind to transactions and price growth. How that plays out depends on the market. So some, such as the US, Canada, New Zealand, have seen very high levels of price growth in recent years, and already starting to see falls. But we're in a very different place, certainly to the global financial crisis. Banks haven't overextended themselves, household indebtedness is much lower, and those on fixed rate mortgages are certainly sheltered in the short term at least. So where does this leave prime residential markets? Well, as we know, they're far less reliant on mortgage debt. They also tend to be more international in their makeup. So this chart looks at the trend of prices across cities around the world, 30 global cities. It's an aggregate of 30 cities, and you can see those falls from the financial crisis, the impact of COVID, and more recently the bounce back in capital values last year, and certainly rents as we saw that demand for city living really surge. Now this chart drills down a little bit further. It looks at city performance around the world across the last 18 months up to June. Starting with Europe, you can see relatively strong growth in the likes of Lisbon, Berlin, London too, showing solid performance over that period. Compared to the US, where we've seen some pretty spectacular growth in recent months, Miami in particular seeing growth in excess of 10% in the 2 6-month periods most recently alone. Now it's important to consider that in the context of values. So Miami, Berlin and Lisbon all moving off much lower bases. London stands 6th, and Hong Kong still by far the world's most expensive prime residential market among world cities. Now, this leads me nicely onto the picture in Asia, which is somewhat more mixed. So on the far left, we've got Seoul, to some extent an outlier, very strong domestic economy, some unique sort of tax incentives have continued to drive growth. But look at those mainland Chinese cities and the sharp fall in growth over the 6-month period, most recently to June, and then the year prior. Really, of course, reflecting the sort of the COVID situation in China and a general economic slowdown there. And finally, Dubai, really interesting sort of emerging world city, booming off sort of in many ways off the back of the energy crisis that we've been experiencing. Lots of in-migration and really kind of catching up after many years of underperformance. So turning briefly to rents, this chart shows prime residential rental growth in the first 6 months of this year. Star performers have been these big megacities, London, Singapore and New York, as well as some of those with more of a kind of lifestyle play. At the other end of the spectrum, you've got some of the Chinese cities and indeed Hong Kong at the far end. So what is the outlook for prime residential markets at a global level, considering the global economic headwinds we're facing? Well, Firstly, inflation and interest rates will certainly weigh on sentiment, but of course prime property is less reliant on debt financing. It remains an attractive asset for wealth preservation as well. The global headwinds and rising interest rates we are seeing are likely to lead to slowing growth, certainly in the near term. And certainly the strong US dollar does put US dollar denominated buyers in a strong position. And worth pausing on that before I talk a bit more about London. This chart shows what $1 million buys you around the world and how that's changed since the start of this year. It factors in both price changes and exchange rates. So on the left, you've got the likes of Cape Town, Tokyo. You can get more than 30% for your money to US dollar buyers. European cities too, and indeed London seeing a significant boost. And certainly if we're talking about Singapore dollar buyers, they make a saving of around 10%. That's just this year alone. And I'll talk a bit more about this in the context of London in a bit. So when buying a property, it isn't just the price of property itself that needs to be considered. There are other sort of taxes and fees and other costs that come with buying. We've done a little scenario around this to compare, again, global cities on a like-for-like basis. So we look at a few things. We look at specifically a non-resident foreign buyer. They buy a $2 million property in this case, held for 5 years. It's not a main residence, then sell the property. This particular scenario, there's no capital growth applied, so no CGT is applied here. So this is the output from that. It's expressed as a share of purchase price value. So when it comes to costs, the highest costs can be seen in Vancouver, Singapore and Hong Kong. A lot of that is because of the additional stamp duties to foreign buyers and indeed additional properties. Interestingly, London at the lower end, most of the costs associated with purchase. And then at the very sort of lower end, you've got the likes of Dubai and Shanghai. But again, sort of turning to London, the recent stamp duty savings associated with the mini budget add a sort of additional $2,500 on this particular scenario. So turning more specifically to the prime London residential markets. So I'll start with a bit of a recap of what's been happening in UK markets in recent years. So following the pandemic, we saw a real burst of activity that was stimulated by record low mortgage rates, to some extent the stamp duty holiday. The UK as a whole, prices grew by 24% since the start of the pandemic. Now, in recent months, we've seen that return to the city story as people return to travel and to their offices. That's certainly fueled London in particular. And such strong demand has led to an acute shortage of stock across both the sales and lettings markets. Now, bringing things right up to date, political uncertainty and the change of Prime Minister clearly led to some caution among buyers and sellers, though certainly having Sunak in place will bring some stability. The inflationary environment and interest rates has also put a squeeze on buyer spending power. But as we've heard, there remains a compelling currency advantage, and that's certainly continued to benefit London in particular. So turning to the rental market in a bit more detail, because it's performed particularly strongly in 2022 so far. So demand continues to outstrip supply. The shortage of stock that we've seen is particularly noticeable in the rental markets. Throughout the pandemic, we saw a number of accidental landlords come to the market who couldn't sell, but as a result of the stronger market, they've returned to the market, and supply has diminished to an extent. Rents are up 14% this year in prime London. That's the highest average annual growth since our records began in 1979. And looking ahead at the rental markets, there are 4 key trends that we expect to shape them going forward. Firstly, a weaker sales market means that supply is likely to increase. although this isn't going to be enough to make up for the severe shortages we've seen in the last 2 years. Rising interest rates and requirement for energy improvements could deter some new investors, less of a concern, of course, if you're buying new build. And short-term growth will certainly continue to be driven by that ongoing imbalance between supply and demand. I think one headwind is the challenging economic backdrop we are facing, and of course the cost of living squeeze that will mean, and in turn potentially sort of tightening budgets as a result. So that was rental markets. What about capital values? How have prices performed in recent years? So this chart shows that story since 2019. I've shown it here for prime central London and for prime London as a whole. Values are 2.4% above their pre-pandemic levels in prime central London, 6.4% in prime London as a whole. Recently, growth is still positive. It has plateaued over the summer. Now, this chart only shows performance since 2019. Prime London prices as a whole are down by 18% since 2014, their 2014 peak. But in dollar terms, they've actually fallen by 47%. So clearly a very strong currency play there. Now, this leads me on to some of the current market conditions. Certainly the big headwind in the sales market is the rising cost of mortgage debt. As this chart shows specifically for the UK, rates have risen sharply and are likely to continue. Now, while we might see the rate rises soon slow, they are likely to remain high until well into next year. That's when the Bank of England might start to think about lowering base rates again. Of course, that's all dependent on inflation coming under control first. So what does this mean for buyers? Well, they're likely to become more stretched. This chart shows typical payments as a percentage of income, and you can see how that's ticked up in the last few quarters. On the flip side, borrowers are on fixed rates, so mortgage regulations and stress testing that we've seen in recent years means that those who are coming to the end of their fixed-term mortgages should be able to weather those higher rates. This chart shows that for the last 5 years in particular, a lot of new lending has been for 5-year fixed deals. So again, those people are more sheltered for now. And more forecasts for, most forecasts are for the base rate to peak next year, gradually fall to a neutral rate after that. And that means that most people should be able to weather the worst of it. So the other thing to remember is that prime markets are less reliant on mortgage finance. So Savills' own data shows that just over half of buyers are cash buyers, meaning that they are likely to be insulated from some of the recent economic headwinds. So looking ahead, we expect to see a lower transaction market, much more dominated by needs-based buyers and sellers. Cash will again become king, and we're likely to see some downward pressure on prices. But it also means that those who do put their plans on hold are going to seek sanctuary in the rental market. And given that rental market's been so strong of late, that's going to only put greater pressure on rental prices, which is positive, of course, for those investing in it specifically. So that sets the scene for London's residential market. I'll talk a little bit more about London's fundamentals more generally now. So there are certain things that make London an attractive place for people to live, work, play and invest. To name just a few, London has exceptional international connectivity, 6 international airports, sees over 175 million passengers per year, a world-renowned higher education sector, of course an exceptional business environment, and just to name one other example, London's time zone means that its business day overlaps with other global markets. There's therefore no surprise that London is the top destination globally for cross-border commercial real estate investment, averages 15 billion per year. This chart shows it comfortably ahead of Singapore and Sydney, its next nearest competition in this area. And as a major world city, London benefits from a diversified economic base across various professional services, creative sectors, tech and knowledge industries. So to highlight just a few of those, this is the Global Financial Centres Index, London in second position, a position it's held for some time. Its next nearest European competition is Paris, down there in 10th. And it's interesting that's held that position even in spite of Brexit. And you know, in my team we do a lot of work around global city competitiveness, and it's interesting that London consistently ranks very highly, particularly tech is another good example. Again, its nearest European rivals, Berlin, Stockholm, Copenhagen, are some way behind, and certainly scale and access to funding a key really to London's success. So a string to the city's bow is its higher education offer. So there are 4 universities in London that are ranked in the top 50 of the QS World University Rankings, and that's clearly a huge draw for international students. And interesting, this chart looks at the progression of those students in recent years, and applicants from outside of the EU has reached record levels in recent years. Applicants of China in particular have seen a significant increase of 21%. And finally on London, before I talk a little bit about Nine Elms, these are findings from our client applicant survey, and it shows what they are looking for in a place to buy in London. It's interesting that proximity to open space is most important, along with access to a tube or train station. And this actually leads me quite nicely onto Nine Elms, because it does tick those boxes specifically. So Nine Elms is the largest and most central regeneration area in London. It is within walking distance of Westminster. It's 227 square hectares, making it bigger than Hyde Park. The area has capacity for 20,000 new homes, 25,000 jobs, and it's estimated there could be 33,000 people living there by the end of this decade. So Nine Elms has a significant commercial offer. There's scope for up to 6.8 million square foot of commercial space. So that's offices, retail and leisure. Major occupiers include Apple, where its campus is located, the US Embassy of course, Penguin and DK Publishing houses, of course many independent retailers, restaurants and bars as well. Now the development's been underpinned by the extension of the Northern Line. That's brought 2 new stations to the area, and that's helped to increase footfall. It's given confidence for retailers to open. And really interestingly, our previous research has shown there is an infrastructure premium. So we've done some research historically into the Jubilee line, and when that opened, we saw prices continue to grow at a higher level than the wider market in the years that followed. So what Nine Elms has done particularly well is the way it has emphasised place and maintaining the character that it has and developing its own culture. So in the industry we talk about placemaking, but what we really mean is, you know, what makes this place interesting, what makes it somewhere that people want to visit. And this really just shows kind of the breadth of the offer in the area. So cultural venues, galleries, open space, the linear park, and of course the power station itself. So moving on to residential, this chart shows the 8,000 private homes that have been built already, and the rest that are in either under construction or pre-planning. I think the standout here is that half the homes already have been built, so this is already becoming an established place. And finally, just talk a little bit about who is already living in the area from some of the research we've been doing. So the market is very much dominated by young tenants. Most renters, starting with the rental market, are British. The remainder primarily North American. Chinese tenants are also present. 15% of those are students. And interestingly, nearly 60% stated lifestyle as a reason for renting in 9 Elms, and that compares with 30% across all prime London, really kind of reflecting that sort of leisure and lifestyle offer. Also a significant proportion relocating for employment, again reflecting the fact this is a sort of business district in its own right, but also within walking distance of Westminster. And finally, who are they? Who lives here? Well, this chart shows the average age band compared to London as a whole. You can see they are younger than average, 37% are under 40, 51% among those who are renting. A small number have children, but in essence, it's quite diverse. And I think one of the sort of overwhelming factors is how much of a success this place already is, and certainly there is plenty more to come. So that finishes my presentation.